As of 10:17 a.m. Eastern Time on November 13, 2025, Rezolve AI, trading under the ticker RZLV, is currently priced at $3.17, and it is struggling, down about 2.0% on the day. The stock is trading on volume of about 1.8 million shares, well on its way to another active session, and it's fighting to hold a line after hitting an intraday low of $3.12. Now, that price movement is what creates the immediate puzzle. If you only looked at Rezolve's official press releases, you would expect this stock to be at all-time highs. The expectation that management is selling is one of a company on an unstoppable trajectory. Just yesterday, the company announced it had hired a new team of senior executives from a who's who of big tech, Apple, Google, and Microsoft, all joining to lead the company's global expansion. This came just a week after the company was validating comments from Amazon's CEO about agent commerce, effectively claiming that Amazon is confirming Rezolve's entire business model is the future. This is all on the heels of their last earnings report on October 1st, which was by all accounts a massive beat. They reported 426% year-over-year revenue growth, beat analyst consensus, and most importantly, raised their 2025 annual recurring revenue guidance to $150 million and set a new 2026 target of $500 million. This is the expectation: a high-growth, disruptive AI company validated by industry giants with a clear path to massive scale. But the reality of that $3.17 stock price tells a completely different story. The reality is that this stock is a war zone. It is one of the most contentious names on the market, caught in a violent tug-of-war between a powerful bull narrative and an extremely aggressive short seller campaign. The stock's inability to hold gains despite the flashy press releases shows that the market is deeply skeptical and that the bear thesis is having a significant impact. The stock fell nearly 6% just yesterday on a heavy volume, and today's weakness continues that trend, suggesting that for every optimistic analyst, there is a seller who believes this company's foundations are flawed. The reality is that the market is not buying the hype at face value, and the reason for that is a significant and detailed short seller attack. This is where the story gets critical. This isn't just normal volatility. Rezolve is under significant short seller pressure. As of the most recent data, the short interest stands at over 8% of the public float. That is a significant number, representing over 12 million shares being held short. But the key figure isn't just the percentage, it's the cost. The borrow fee rate, which is the fee short sellers must pay to borrow the shares, is currently hovering around 8.6%. To put that in perspective, a safe, easy-to-borrow stock might have a fee of 0.3%. A rate of over 8% is high. It signals significant demand from short sellers who are willing to pay a steep price to bet against the company. But the most alarming piece of data, and the one that investors need to be aware of, is the fail-to-deliver data from late September. For those who are not familiar, a fail-to-deliver, or FTD, occurs when a party in a trade fails to deliver the shares by the settlement date. While this can happen for administrative reasons, massive spikes in FTDs can be a sign of extreme shorting activity, including potentially naked short selling. In the last week of September, coinciding with a major short report, Rezolve's FTDs exploded. We are talking about numbers like 7.5 million shares failing to deliver on September 26th, and another 7.6 million on September 25th. These are not small numbers. The value of these FTDs was over $50 million on those days. This data confirms that a massive, coordinated shorting campaign was underway. This campaign is not built on guesswork. It is anchored by a formal short seller report from Fuzzy Panda Research, which was published on September 29th. The report is brutal. It alleges that Rezolve is faking its ARR growth by acquiring failing AI startups. The report claims that the company's 2024 revenue was a minuscule $190,000, not from AI, but from soccer ticket sales. The most damaging allegation is that Rezolve's proprietary LLM and Brain Suite are, in the report's words, nothing more than a worthless ChatGPT wrapper. This report essentially accuses the company of being a marketing shell, not a real tech company. This is the short thesis in a nutshell, that the $150 million in 2025 ARR guidance is not real, that the technology is not proprietary, and that the company is burning cash with no viable product. What's your take on this? Do you think the Fuzzy Panda report is a classic bear attack, or do they have a point about the ChatGPT wrapper claim? This short thesis is compounded by another major risk factor, a legal battle with a financier named Yorkville. This was a topic of heavy discussion on platforms like Reddit a month or two ago. The company had a $250 million equity purchase agreement, a lifeline of sorts, but now the company is in a lawsuit over that funding. The bear case is that the company is being starved of the very capital it needs to survive, and that this lawsuit proves it's uninvestable. The company's counter, of course, is that it is the one suing Yorkville for breaching the contract by refusing to provide the committed funds. But for the market, the headline is just lawsuit and funding risk, which is poison for a growth stock. So how can you, as an investor, navigate this? You have to become a data watcher. You can find the official short interest data yourself. It's published by NASDAQ every 2 weeks. You can track the borrow fee rates on platforms that service active traders, like Fintel or iBorrowdesk, which is what we're looking at. A sharp spike in that fee is your signal that demand to short is increasing. And you can monitor the FT day data, which is released by the SEC, to see if settlement failures are piling up again. This is not a stock for the faint of heart, and it is absolutely critical to avoid chasing a potential short squeeze. The low days to cover ratio, currently at 1.1, suggests that shorts can cover their positions relatively quickly, making a sustained explosive squeeze less likely. Now, with all that said, there is a very clear and powerful bull case that directly counters the short report. The short report focused heavily on 2024 data. The company's October 1st earnings report, with its 426% revenue growth, 95.8% gross margins, and $230 million in cash on the balance sheet, seems to directly refute the claim that the company has no revenue or is faking its growth. The company is actively acquiring other businesses like SmartPay and Subsquid to build its agentic commerce infrastructure, which suggests it is executing a real plan. The bull case is that Fuzzy Panda's report was a hit job based on outdated information, and that the company is now in its hyper-growth phase. Analysts who cover the stock seem to agree with the company, with multiple buy ratings and price targets far above the current price. So, what is Rezolve AI? The company presents itself as the plumbing for the next generation of e-commerce. Its Brain Suite platform is designed to integrate into a retailer's app or website and use AI to manage the entire customer experience, from engagement and product discovery to a frictionless checkout. The idea is that it provides AI as a service for major brands like H&M and Ferrero who are listed as clients. It makes its revenue through a combination of subscriptions to its platform and, more importantly, transaction fees on the gross merchandise value that its platform processes, which the company claims was over $50 billion in early 2025. This is the model that has analysts excited and has attracted those new executives from Google and Apple. Looking forward, the battle lines are clearly drawn. The future of this stock depends entirely on one thing: the numbers. The bear case from Fuzzy Panda and the funding risk from the Yorkville lawsuit create a massive wall of doubt. The bull case, built on the $150 million and $500 million ARR guidance, the $230 million in cash, and the validation from industry giants, is the battering ram. The next few quarters are everything. If Rezolve comes out in its next report and misses that $150 million ARR trajectory, or if cash burn is accelerating faster than expected, the short thesis will be proven correct, and this stock could see significantly lower levels. The risk is that the company is using its acquisitions to buy revenue, and that organic growth is not as strong as the headline numbers appear. However, if the company delivers, if it meets or exceeds that $150 million ARR target and shows a clear organic path to its $500 million for 2026, the short thesis will be destroyed. The 8% short interest will be forced to cover, and the combination of a short squeeze and institutional buying could send this stock flying. The new executive team is a major catalyst. If they are truly on board, it suggests they believe in the technology and the $500 million target. You don't leave a top job at Apple or Google to join a ChatGPT wrapper. This is the ultimate expectation versus reality stock. The expectation is a category-defining AI leader. The reality is a company under a coordinated bear attack fighting to prove its technology and its financial reporting are legitimate. The weakness today shows that the bears are still in control of the daily price action. I have to ask, for those of you who are watching this, comment below with what you believe. Is Rezolve AI the real deal that is currently under attack, or is the smoke from the short reports a sign of a real fire? In summary, the story of RZLV is not just one of growth, it's one of conflict. The company is presenting a vision of a 500 million ARR future, while short sellers are presenting a reality of $0 AI revenue and faked technology. The high borrow fees and massive FTD spikes from September are not just noise, they are evidence of a